Good afternoon, everyone. Today we start our presentation on company law. It's our monthly webinar on compliance awareness. So, let's start it. We will delve into compliance and company law and explore the latest amendment in other relevant regulation. Our focus will be on understanding the recent changes and their implications for corporate governance and compliance. We will break down key updates such as new procedural requirement and reporting obligation. So I hope by the end of this session, we will have a clear picture of how to navigate this amendment effectively, ensuring your company stay ahead of the curve and adherence to all legal requirements. So moving ahead, this is our content slide, what we will cover in the upcoming slide. So we start with the introduction, some basic introduction of what is company. So it's a separate legal entity which is incorporated under the Companies Act. It has a perpetual succession. So for example, if any director or owner of the company dies, the company will continue to be forever until it is winding up. So it has a common sale and the limited liability. So under the Companies Act, there are three types of companies: private, public, and one-person company. We will cover chapter-wise under the company law. So our first is the incorporation of company and matter incidental. So in this chapter, many compliances are event-based, but we will cover only recurring compliances. Incorporating a company involves key recurring compliances, two of which are essential. So first, the company must declare and maintain a registered office which serve as its official address for receiving letter and communication from government regulatory bodies. The regulatory office must display the company name and address visibly on the outside of its premises, ensuring compliance with the Companies Act. The board must be in a conspicuous position and legible. And second one is director must disclose any interest they have in other firms to maintain transparency and avoid conflict of interest. The first director are required to file the written consent to act as a director, or even also जो भी directors आगे appoint होंगे, they need to file consent to act as a director, which is attached to Form DIR 12 during submission. Next is the allotment of securities, which is chapter 3rd. We will discuss the compliance related to share allotment. When a company with a share capital allots securities, it must file a return with the ROC within 30 days using Form Pass 3, which include details like the number and class of securities and allottee's name. Timely filing is essential to avoid penalties. Additionally, unlisted companies are required to submit a Form Pass 6. It is a half-yearly reconciliation of share capital. This form is certified by the company secretary or CA, which ensure transparency in reporting any changes in share capital. Next, we will cover deposits. So now let's talk about deposit. So learn from the basic meaning. So deposit refer to any money received by company through the deposit, loans or other prescribed form as per section 73 to 76 of the Companies Act. However, certain transactions are included from the definition of deposit, such as funds from government, international bank. Companies are required to file Form DPT-3 to report information about deposit or any outstanding loan or money received. Additionally, they must maintain a register of deposit that includes details like depositor's name, address, deposit amount. So these are the compliances of deposits. Next, we cover compliances related to the charges. So we will understand from the basic meaning to the compliances part. A charge is a right created by company on its asset, present or future, in favor of a financial institution or bank when borrowing fund. So once charge is created, the company must register it with the ROC within 30 days using form CHG 1 or CHG 9. It is for the debentures. It is crucial because it secures the lender interest in company's asset. If the company missed this deadline, they can file up to 300 days later with an additional explanation and fees. Also, maintaining a register of charges is required to ensure proper record keeping. Next is the management and administration. Now we come to the crucial topic, management and admin. First is the annual return. The annual return is key filing that provide essential information about the company, including detail of promoter, member, meeting, and director remuneration. It is signed by both directors, CS, or by the PCS if company does not have a company secretary. So next, as per section 88 of the Companies Act, every company is required to maintain registers like registers of debenture holder, beneficial owner, etc. It is a statute. It's a mandatory compliance. Finally, the concept of significant beneficial owner, which was introduced to identify individual who holds a significant interest in the company. This ensured greater transparency in company ownership. Let's quickly understand the compliances related to SPO. So every SPO must file a declaration in Ben 1 within 90 days of rules coming into effect, or within 30 days of any ownership change. The reporting entity, after receiving this declaration, must file a return in Ben 2 within 30 days. Additionally, the company must maintain a register of beneficial owner in Ben 3, which is available for inspection. So if a company needs further information, it can issue a notice in Ben 4 required the person to furnish detail of their beneficial interest. Now let's cover another topic of AGM. It's a vital event where management interact with shareholders, discussing the company performance and future plans. And AGMs must be held within 6 months of financial year end, typically by 30th September, and the gap between the two AGM shall not exceed 15 months. ROC may grant an extension if needed. Moving on, minutes of the meeting, it's a document. All important discussion and decision made during meeting shall be documented in minutes. Draft minutes shall be circulated to director within 15 days, and they have 7 days to confirm or comment. Moving on is a MGT8 certification. On annual return, MGT8 certification is required for companies with a significant capital or turnover, and any false certification by CS will lead to fine ranging from rupees 50,000 to 5 lakh. So there are other two registers of security holders and the foreign registers. So every company which issue oral or debentures or any other security shall maintain a register, separate registers of debenture holders in form MGT2. If permitted by articles, a company may maintain a part of its register which known as foreign registers in any nation outside India in the same format as the principal or major register. Dividend. We cover the compliances related to dividend. IEPF introduced by the government under the section 125 is designed to safeguard investor interest and raise awareness. Companies must file a form IEPF to report amounts transferred to IEPF, while form IEPF2 is an annual statement of fund unclaimed for 7 years, which is filed within 90 days of AGM. Recently, on 17th July 2024, MCA simplified the IEPF filing process by merging form. So IEPF 3 will now be merged with IEPF 4 and IEPF 7 will IEPF 1, reducing compliances burden. Form IEPF 4 is specifically used by company to report shares transferred to IEPF due to unclaimed dividend. This change aims to make the process smoother and more efficient for companies. Accounts of the companies. So there is another crucial topic, CSR. So learning from wastage, CSR is all about companies contributing to society and environment for the greater good. Under Section 135 of Companies Act, certain companies are required to allocate at least 2% of their average net profit from the past 3 years to CSR activities. This include project listed in Schedule 7. So there is a Schedule 7 under the Companies Act which have the list of projects जिसमें हम CSR contribute कर सकते हैं. And companies meeting the following criteria of turnover, net profit must comply with Section 135. Since April 2021, entities undertaking CSR must file Form CSR1 for their projects, and NGOs needs to be registered with the central government. Additionally, from the financial year 2020-21 onwards, company must submit a CSR report in CSR2. For the year 2023, this form must be filed by 31st March to avoid penalties. These regulations ensure that CSR activity are both transparent and impactful. In case company fails to comply with the 135 provision, the company will be punishable with a penalty of rupees 1 crore or twice the amount required to be transferred by company to the CSR fund. So in this condition, whichever is less will need to be is the penalty amount. Filing of accounts and internal audit. Accountability of a company to the stakeholder is mandatory, and it is done via financial statement, disclosure, board report, auditor report. So form AOC 4 is used to file the financial statement for each financial year. In case the consolidated financial statement, the company shall file AOC 4 CFS. Financial statement adopted at the AGM along with a consolidated financial statement and document which are attached to the financial statement. The due date of filing is within 30 days of the AGM. Moving ahead is the internal audit. The Companies Act 2013 mandates internal audit for certain companies in India. These are independent assessment by a qualified professional who evaluate a company internal controls. So every listed company or and unlisted public company with a turnover of 200 crore, paid up share capital of 50 crore, and outstanding borrowing is 100 crore, or outstanding deposit is 25 crore. Even the private companies are also covered with a turnover of 200 crore or outstanding loan of 100 crore shall conduct the internal audit. Next is audit. So statutory audits are a fundamental requirement for all companies, irrespective of turnover or size. As per the Section 139, an auditor must be appointed at company first AGM and will serve until the conclusion of the sixth AGM. Though their terms needs rectification at each subsequent AGM, these audits are conducted annually and must be completed within 6 months of financial year. So for a financial year ending on 31st March, the audit must be wrapped up by September 30th. So if you appoint the auditor, you need to file a form ADT1. Next, the topic cost audit. Let's delve into cost audit, an essential process for verifying cost audit and ensuring adherence to the cost accounting plans. Companies in the regulated sector as listed in Annexure A. So there is a annexure in which there are two sector regulated and unregulated sectors. So for the regulated sector, the limit is different, and for the unregulated sector, limit is different. So, for example, your company is a sugar or industrial alcohol producing company. It is covered under the regulated sector, and if its turnover exceed 50 crore, so it needs to conduct the cost cost audit. For non-regulated sector, the threshold are higher. A cost audit is required if the overall turnover exceed 100 crore and individual service turnover is above 35 crore. Additionally, any company with an overall turnover of 35 crore must maintain the cost records. Next, the another part of this presentation, appointment of director. Under the Companies Act, the rules for director are very clear. Public company must have at least 3 directors, while the private need at least 2. So additionally, every company must appoint a director who has been residing in India for at least 182 days in the previous calendar year, which is called a residential director. Independent director plays a crucial role in enhancing corporate credibility and governance. Unlike manager or whole-time director, they are a non-executive, bring an unbiased perspective to the board. So the limit is different for the independent director. Apart from that, every listed company needs to appoint a woman director, and public company with a paid up share capital of 100 crore and turnover of 300 crore must appoint a woman director. It's ensure women empowerment and transparency in the board. Private company is exempted from this provision of appointment of women director. Appointment of director covers then or any changes made in their appointment. There is a 8-digit unique identification number which is allotted by central government to each individual who wants to be a director of a company. Once allotted the DIN number, it has a lifetime validity. So if you are a director, it is essential to promptly notify any change in your personal details such as address, date of birth, email, or even your PAN or Aadhaar card through Form DIR 3. Additionally, you must inform every company you are associated with about your DIN using Form DIR 3C within 1 month of receiving your DIN approval. Appointment of director. Moving further in this topic, all directors with a DIN allotted on 31st March and whose DIN is in approved status must now submit their KYC detail to MCA. This requirement extends to disqualified director as well. For financial year starting from 1920, it is mandatory for director to file Form DIR 3 KYC before 30th September of the following financial year. So, for instance, director with a DIN by March 31st March 2023, they must file DIR 3 KYC by September 30th. Apart from that, whenever you appoint director or he leaves the employment, there is a form DIR 12 needs to be filed. The due date is 30 days from the date of appointment. And if you appoint a director, you need to take the consent that now I wish to be appointed as a director in the company. Intimation of disqualification by director. So earlier, director has to inform the company about company's related disqualification, such as non-filing of financial statement, annual return. But now there's amendment. After it, director have to inform about company-related direction, disqualification, and their personal disqualification also. And company shall file a report within 30 days of such receipt in Form DIR 9. Meeting of board and its power. For smooth board operation, director there is a certain compliances जो हमको बोर्ड मीटिंग करने से पहले भी करनी होती है. So for its smooth board operation, director must be notified of meeting at least 7 days in advance using their registered address in person or by post or electronically. So meeting can be scheduled on any working day, excluding public holidays. So regarding the committees, listed company and public listed company with a significant capital or turnover must establish an audit committee with at least 3 directors. A majority of them must be independent, and a nomination remuneration committee with at least half of its member being independent. So this committee oversee the qualification of directors or कौन से the prospective directors, they have the database maintained with them. Additionally, companies with over 1,000 shareholder of security holders are required to form a SRC, Stakeholder Relationship Committee, which is chaired by non-executive director to address and resolve stakeholder grievances effectively. Moving ahead, there are other compliances in this chapter. So when a company passes a resolution in its meeting, it must file a form MGT 14 with the ROC within 30 days as mandated by Section 117 of the Companies Act. This requirement ensures transparency and proper record keeping of decisions made by companies in their meeting. However, certain resolutions like those involving routine business transaction are exempt from filing. It is crucial to pay attention that MGT 14 is used for various three resolution, including special resolution, managing director appointment, and any other resolution requiring a special majority. Moving ahead, Section 184 require director to disclose any personal interest in other entities during the first board meeting on whenever changes occur. So this form MBB1 used for this disclosure is essential to avoid conflict of interest and maintain integrity of board decision. Appointment and remuneration of managerial personnel. Under the Companies Act 2013, certain companies must appoint KMP to oversee their operation effectively. The critical group includes the CEO, MD, company secretary, whole-time director. Additionally, the board may designate other senior officer as KMP, provided they are no more than one level below the director in whole-time employment. These appointments are pivotal for ensuring streamlined management. Next, the secretarial audit. Secretarial audit is a compliance audit. It is a part of total compliance management in an organization. It is an effective tool for corporate compliance management which help to detect non-compliance. Secretarial audit covers 5 laws: Companies Act, Securities, SCRA Act, Depository Act, FEMA Act. So this is the applicability of the Companies Act, and company secretary in practice need to issue an audit report in MR3. Now I would like to hand over this presentation further to Mr. Rohit Khurana. Sir, please go ahead with your presentation.
Thank you, Nena. Good afternoon, everyone. Now we will intend to cover some key changes in 3 laws: company law, income tax, and goods and services tax over next few slides. So starting off with the key changes in company law. Nena? Right. So the first one, MCA during the COVID period had introduced certain provisions for companies to hold their general meetings through video conferencing or other audio-visual means. This relaxation was introduced initially for a limited period and then later extended. MCA has now decided to allow companies whose AGMs are due in the year 2024 and 2025 to conduct their AGMs through VC or OAVMs on or before 30th of September 2025. The ministry has also clarified that this general circular should not be construed as extension of any statutory time for holding AGMs. Another key deadline approaching was on 30th of September, where MCA has mandated dematerialization of dematerialization of shares for companies other than small companies, which means small companies are those companies whose paid up capital is not more than 4 crores and turnover does not exceed 40 crores. However, MCA has given producer companies a key relaxation and pushed out the deadline to March 2028, hence giving these companies an additional 5 years to meet the requirement for dematerialization. A producer company is one where the objects or activities are specified in Section 378B and are registered as producer companies. Their prime objects are farming, production, harvesting, procurement, grading, pooling, marketing, selling, or export of primary products of its members and allied objects. Next amendment is in the Companies Compromises, Arrangements and Amalgamation Rules 2016, is related to the cross-border mergers and amalgamations. According to the new rules, any merger between a foreign company incorporated outside India and a wholly owned subsidiary company incorporated in India will now require a prior approval from the RBI by both the companies. In addition, the Indian subsidiary must obtain approval from the central government for said inbound merger. The companies would also be required to furnish a declaration for applicability or non-applicability of FEMA. The Ministry of Corporate Affairs has announced significant changes by replacing Form ADJ with the newly updated version. This update is part of the company's adjudication and penalties of Amendment Rules 2024, which will come into effect on September 16. The Rule 3A establishes an adjudication platform mandating all proceedings related to adjudication, issuing notices, filing replies or documents, presenting evidence, conducting meetings, attending witnesses, passing orders, paying penalties will now be conducted electronically through the new e-adjudication platform developed by the central government. In continuation, the old ADJ form has been discontinued on the MCA portal V2 and now has been introduced on MCA version 3, V3. Moving on to key changes in Income Tax Act. With effect from financial year 24-25, the new tax regime standard deduction has been increased from 50 to 75,000. However, there has been no change in the standard deduction eligibility in the old tax regime with respect to standard deduction. For family pensions, the standard deduction also stands revised from earlier 15,000 to 25,000 in the budget. So for a family pension, the amount of deduction would be 25,000 or 1/3 of the pension income, whichever is less. The thresholds for classifying assets as long-term assets have been simplified. For listed companies such as equity shares, equity-oriented mutual funds, both listed or unlisted, the units of the Business Trust of India Limited, the threshold is 12 months, and for all other assets, the threshold is increased to 24 months. For shares held outside India, the minimum holding period to qualify as long-term asset remains at 24 months. For capital gains, the government had introduced a relief measure for taxpayers affected by the recent changes in the long-term capital gains on property. Under Union Budget 2024, earlier this year, had reduced the tax rate for long-term capital gains from 20% to 12.5%, but removed the indexation benefit, which adjusted the purchase price of the property for inflation. This change significantly impacted people owning real estate. And in response to the public outcry, the government has now allowed taxpayers to choose either of the two options. Option 1, to pay 20% tax on capital gains after adjusting the purchase price for inflation by applying indexation, or pay under the new rules, which is 12.5% under the company's gains without indexation adjustment. The taxpayer can select the option that results in a lower tax liability. However, this relief is only applicable to properties acquired before July 23, 2024. Short-term capital gains in listed companies and equity-oriented mutual funds are now subjected to concessional rate of 15% till the transfer made on or before 22nd July 2024. From such date onwards, this raise has been increased to 20%. As of 1st of October, the proceeds of share buyback will now be considered as dividend income and tax in the hands of the shareholders at their respective slab rates of their incomes. Under the existing provisions, the Indian companies buying back the shares were taxed. Non-residents will need to evaluate any relief available under the terms of a relevant bilateral tax treaty. Changing gears to goods and services tax. The time of supply has been clarified under RCM. In case of supplies in respect of taxes where the tax is paid or liable to be paid under reverse charge mechanism, the time of supply is now clarified to be earlier of the following 3 dates. The date of payment as entered into the books of accounts of the recipient or the date on which the payment is debited in the account, whichever is earlier, or the date immediately following 60 days from the date of issue of invoice or any other document by whatever name called in lieu thereof by the supplier, where the invoice is required to be issued by the supplier. The date of issue of invoice by the recipient in case where the invoice is issued to be by the recipient. GSTR 7 is a monthly return filed by individuals who are registered under GST and who are liable to deduct tax under the Goods and Services Tax Act. This return has to be filed by 7th of every month for the previous month. Filing GSTR 7 has now become mandatory irrespective whether any deduction has been made in the said month or not by all persons required to deduct TDS, hence liable to file GSTR 7. Another change in the Finance Act is the reduction of maximum amount for pre-deposit of filing appeal before the appellate authority. It has been reduced from existing 50 crores to 40 crores. In case of appeal, the appellant needs to deposit the amount of tax penalty or interest on the amounts admitted in the impugned order and a sum equal to 10% of the remaining amount in dispute, subject to a maximum of 10-20 crores. Last but not the least, a key change has been introduced by the GST Act. GSTN is in the process of developing a new functionality called the invoice management system, which will allow the recipient taxpayers to either accept or reject an invoice or to keep it pending in the system to avail in a subsequent date. This functionality would be a major enhancement in the ITC ecosystem of GST. So going forward, only accepted invoices by the recipients would become part of their GSTR 2B to avail ITC, and this would become their eligible ITC. To enable taxpayers to efficiently manage and address the invoice corrections, amendments with their suppliers through the portal, this new communication process is being brought to the portal. This will also facilitate the taxpayer in matching their records, invoices, vis-a-vis what has been issued by the suppliers for availing the correct input tax credit. That was all from me. I'll be happy to take any questions. I guess not. So thank you all for joining in. Hope this. Sorry, Vijay, you had a question?
Yeah. Actually, I'm from Akar Power Gas. So actually, I have one small question. The CSR2 actually. So for 23-24, what is the deadline for that? And what is the due date for that? It's a 31st December or it's the 31st March?
No, so for this year, it has been pushed out to 31st of December. It has to be filed after the annual return and the annual accounts have been filed after AOC 4 and NGT 7 have been filed. So it has to be filed by 31st of December this year.
For this year only. Okay. Got it. Thank you.
You're welcome. Thank you, Vijay. So thank you all for joining in and giving your precious time to our session today. Hope it was valuable. And we'll keep our endeavor on to hold such webinars in future as well and encourage you to join. And if you have any suggestions, please let us know at feedback@complyany.com. Thank you very much. Good afternoon.